talk us through the icebergs that the team have identified that we should maybe be on the lookout for?
The big risk to us is probably the normalisation of monetary policy. That's already started, particularly in the US. Certainly the Fed has already indicated that they're going to go through balance sheet normalisation. They're going to shrink the balance sheet, in other words, take liquidity out of the system. Certainly the ECB appears to be becoming a lot more hawkish at the moment, and I think you might start to see the end of quantitative easing and the start of quantitative tightening within the ECB as well. And I suppose the fear is that central bankers lose control over the process and that inflation actually starts to surprise on the upside, and therefore interest rates and the magnitude of increase in interest rates goes up a lot quicker and more, and quantitative tightening starts sooner and is more aggressive than the market was originally anticipating. I think that would probably be our biggest fear at this point in time. I think political risks have receded over the last 12 months. You know, certainly at the beginning of 2017, I think there were a lot of political risks. I think those have receded, particularly in the euro area. Although it's interesting to note that Angela Merkel still hasn't been able to form a coalition government as yet. So I think that remains a risk geopolitically. North Korea, I think the tensions around North Korea and the US still remain very much an iceberg. And then we mustn't forget the unpredictability of Donald Trump either. You know, he's certainly an individual that can lead to either positive or negative surprises in the 12 months ahead. And then another iceberg, which is probably slightly softer, is the complacency of investors at the moment, because we're operating in a very benign environment where everything looks pretty good at the moment. And if you take the VIX index, which is otherwise known as the FAIR index, it's trading at very, very low levels. Historic low levels. I mean, it's trading around about 9 or 10 times, I think, at the moment. Generally, the average is 15, and if you include the financial crisis, 20. It's a mean reverting index. And I suppose the risk around that is it shows complacency amongst investors. They don't have a lot of fear at the moment, and they're not worried about fear. And as always, I think when you're in a scenario like that, sometimes that represents a risk as well.
Yeah. Ali, maybe we can switch to you. We've spoken a lot about the portfolio positioning and so on. But of course, you're a wealth manager. You have to go and sort this all out for your clients. How do you ensure clients are properly positioned, given that portfolio positioning?
Yeah, given that the markets are high and that we're into the 10th year of a bull run, clients are legitimately feeling jittery about investing new funds. And we've had clients who have been sitting on their hands this year because they've just sold businesses and they're putting their hard-earned cash into the market for the first time. And it is difficult given the levels of the market. So for interest's sake, we actually did a test, and what we did was say, what if you invested your money at the worst possible time, at the peak of each of the last crashes since 1987? That was, 87 was Black Monday, 1997 was the Asian crisis, 1998 was the Russian crisis, 2001 internet crisis, and as you well remember, the GFC, which was 2007. If you invested at the worst possible time and you held your money there for 10 years, would you have done better than just sitting on the cash or hiding the money under the mattress? And we tested it on 3 indices, the JSE, MSCI World, and the S&P 500. And we invested into a portfolio of 60% equities and 40% bonds. And the results were surprisingly reassuring, and they were actually, you would have done much better by investing in a portfolio of 60 equities and 40% bonds over 10 years than having kept your money in cash.